All right. I'd like to take this opportunity and discuss capital budgeting. All right. So this is part one. This corresponds to chapter four. All right. So my plan is to provide you with a little overview of capital budgeting. All right. So you may have discussed this already in Finance 201. All right. So capital budgeting, literally, it means you have to budget your capital. Why do you have to budget your capital? Because number one, your capital is limited, and number two, capital could be put into different uses. So these really means that you should really put your capital to its best use. All right. Just like your time. Okay, your time is limited. You only have 24 hours a day, and your time could be spent on studying, could be spent on sports and other things. But you have to put your time to the best use. All right. Um, so the capital budgeting decision is a very very important corporate financial decision to make. All right. In many cases, it's very risky and a lot is at stake. Okay. So I can give you many examples. For example, this recent COVID-19. Well, I mean, we're still in the middle of it. All right. So the scientists are trying to actually come up with vaccines to fight against this coronavirus. Okay, so we know we have three at least three major vaccines already. All right, Pfizer, Moderna, and AstraZeneca. Okay, Oxford AstraZeneca. Okay, and recently people are talking about Novavax, right? And it turns out, that can actually be quite effective. I think the number is actually over 90%. All right. So, but if you look at this, when the major, vaccines are out, do you still want to actually, put, your resources into developing a new vaccine? Your vaccine may or may not work, and you have to compete against the existing, vaccines for market share and so on and so forth. And no wonder people are saying we should actually ship those, Novavax vaccines to, maybe less developed countries because in the United States we have plenty of, vaccines, available at this moment. All right, so your R&D project in the pharmaceutical companies that could be success, that could be a big bust. All right, that is risky. Okay, um, and I can give you another example. For example, box offices. All right, the Hollywood, big, production, big time movies. All right, it may receive very good box offices, or it could be a big bust. All right, they spend maybe I don't know $200 million on producing the movie, and the box office is lackluster. All right. So, do you want to actually, undertake this capital budgeting project and produce this movie? All right. Other examples could be, for instance, setting up the factory in, let's say, Vietnam to produce, iPhone 12 and so on and so forth. All right. So the point here is, capital budgeting project is risky, but it's very important. And, in many cases, you're talking about mutually exclusive projects. So if you do this project, you cannot do that project at the same time. So you have to pick and choose. You have to rank these two projects. Okay. And in some other cases, we're talking about sunk cost. Right. This is an economic term. So basically, if you spend money on working on a new vaccine, if it is not successful, then maybe the money you spend cannot be recovered, cannot be put into other uses. All right, so this would be referred to as sunk cost. And then in the real world we have taxes, so we may have to understand how to, for instance, incorporate tax when you actually make capital budgeting decisions. All right. So these are all the things you have to consider, and this might be the primary job for the CFO. I'm sure some of you will actually over time become CFO of your company, so this is non-trivial. All right, and this is a little overview. Okay, in this chapter we're going to talk about the basics, and then in chapter 5 we're going to actually have a few more extensions for capital budgeting projects. Okay, all right. So the next thing that I want to discuss is NPV and NPV rule. All right, so we all know what is NPV. All right, NPV stands for net present value. All right, so this is really you take this project and you have the initial investment, and then you also have the expected cash flows from this project in the future. So if you want to calculate the net present value, what you need to do is you discount the future cash flows back to today, and you get the present value of the future cash flows. And then you would have to subtract the initial investment from this present value of the future cash flows, and hence the term net. Okay, it is called net because it's actually after considering or after netting out the initial investment. All right, so that is the NPV definition. All right, so I can actually copy my formula into this. Let's see whether I can actually do that. All right, so if I actually copy and paste, yes, that works. All right, so I have the NPV for any capital budgeting project, and this is calculated as negative I0, which is the initial investment, and then this nasty term here is nothing but the present value of the future cash flows from this project. Okay, and we're talking about M periods here, and R is the risk-adjusted discount rates. All right. So I need to actually, emphasize this a little bit. Risk-adjusted discount rates. Okay, it's actually reflecting the risk of this project. Okay, all right. So that is NPV, and NPV rule. Well, NPV rule is the decision-making rule. All right. So this actually is, quite, easy for you to, for you to understand. So basically, if you're considering single projects. Okay, if you're considering single projects, take it if NPV is positive. All right, discard it if NPV is negative. Well, if NPV is 0, then you're really indifferent. You don't care because it does not decrease your shareholder value. It does not increase your shareholder value. All right, indifferent if NPV is equal to 0. Okay, so that is the, it's a decision-making rule. All right, in other words, you would have to calculate the NPV and then look at, whether you want to take this project. Okay, if the NPV is positive, then, taking this project would actually increase the shareholder value. All right, so that's why, you want to actually take it. All right, for multiple projects. Okay, so if you actually have multiple projects for you to consider, then you should actually rank them, on the basis of the NPV. Okay, and then you should actually calculate the NPV for all these different projects you may actually be able to consider, and then if you can actually take all of them, take all of these positive NPV projects, that's great. If you cannot because you have the capital constraint, then you would have to economize your capital and again put your capital into best use by picking the one that offers the highest NPV and the second highest NPV and so on and so forth. All right, so that is for multiple projects. All right, so let's just look at one example here. This is the basic. All right, example number 1 on your lecture notes. Okay, again, please have your lecture note ready on your side so that it is easier for you to refer to. All right, so let's just say, well, I want to actually let's see, I want to actually consider example number 1 here. So let's just assume you're trying to decide whether to undertake one of 2 projects. All right, project A, that actually involves buying a very expensive machine, and because the machine is actually more expensive, it can actually produce a better product at a lower cost. Okay, so the cost for machine A is actually 1,000, and if you buy this machine, you're going to produce the products, and you can actually sell them, and you can actually expect cash flows of $500 for the next 5 years. All right, so that's project A. Okay, project B, on the other hand, is actually about buying a cheaper machine. So it's costing only 800, but it produces similar but smaller cash flows because it's a cheaper machine. So the cash flow in the following 5 years, that's actually 420. All right. So you have project A, and you have project B, and you're actually trying to decide what is the NPV for these 2 projects, and based on the NPV, what can you say about these 2 projects? Okay, so I'm going to actually look at year here. This is today, and I'm building a vertical timeline, and this is 1 year from today, and we have 5 years here. Okay, and if you look at a project A, you're going to spend $1,000, all right? So I can put down a negative 1,000 because that's the initial investment, all right? And then project A is going to produce cash flows of 500 each time for the following 5 years, okay? So project B, well, that's going to actually cost 800, and it's going to produce 420, for the following 5 years, okay? And here, the discount rate, all right, so the discount rate this is the risk-adjusted discount rate, and this is 12%, okay? We're saying the appropriate discount rate here is 12%. And we save you from a lot of hassle, in deciding what is the appropriate discount rate. We just provide you with this number. If you are the CFO of your company, you may have to actually estimate or build up your estimate for what is the appropriate discount rate. Okay, so now I want to calculate the NPV for these 2 projects. All right, NPV for A and NPV for B. Now there are many different ways for you to get the net present value. If I want to actually go by the definition, I'm just going to look at present value of each cash flow, from project A. All right. So I can actually build a formula here and copy down. Okay. So I'm just going to discount this 500 by 1 plus the 12% here. Okay. I can type down 12%, or I can use cell reference. All right. But if I use cell reference, I would have to lock down the cell reference here because this is the same discount rate I'm going to use to discount the other cash flows from project A. So this is known as the absolute cell reference, okay? And this is discounted for 1 period, all right? So, if I do it this way, I'm going to get the present value of the first cash flow from project A. All right, that's $446.43, and I can copy this down here, and I get the present value of the other cash flows. And now I can actually say NPV for A. All right, so I'm going by the definition here, so I'm just adding up the present value of the future cash flows, and then I'm netting out the initial investment. So that would be the net present value for project A. It's a positive NPV project. You can actually increase the shareholder value by $802, okay, if you take this project A. All right, so I can do the same thing for project B. So present value of each cash flow from project B here. Can I copy this across? Some of you might be a little concerned or a little worried. So let me just copy this across and look at this one here. Well, Excel says you're going to divide F 19. Well, that's not what I want. I want to actually divide the 420 by 1 plus the C25, which is the discount rate, and I want to actually, discount this only for one period as well. So that would be a good discounting formula if I want to get the present value for project B. All right. So that is 375. And now I can actually, put my cursor here and double click. Okay. Well, nothing happens, so I may have to drag this down. All right. So that is the, present value of each cash flow from project B. Okay. You can actually double check this is doing the right thing. Okay. Now I can say NPV for B. Well, that's going to be, again, the summation of these present values, and then you net out the initial investment. Now, I already signed the initial investment as a negative number, so I'm just going to add. All right, so project B has a lower NPV, but still it's positive, 714. All right, so this, is very much doable, but, it's a little, time consuming. All right, so I'm going to share with you the Excel function. It's called NPV function. Okay, but listen up. The Excel NPV function only calculates the present value of the future cash flows. It does not subtract the initial investment. Okay, let me repeat. The Excel NPV function only calculates the present value of the future cash flows. It does not subtract the initial investment from the present value of the future cash flows. So in this regard, the Excel NPV function is wrong. It is wrong because this is not the finance NPV we're talking about, okay? But, as long as you understand where it is wrong, you can still use it. Now, I'm going to show you how we can actually use it, all right? So the discount rate is 12%. I can actually, look at the C25 here, and I'm going to look at the future cash flows, okay? When you are looking at the NPV function, you only include the future cash flows, and then you manually subtract the initial investment. Well, in this case, again, the initial investment is is negative, so I just add. All right, so now you see that this actually replicates the number, except it's actually in percentage, format, and I don't like that, so I can actually format this as a dollar. Okay, 802.39. That's actually replicating this number here. Okay. So that is really handy as long as you are aware where the NPV function is actually messed up. All right, so let me just do it again this time. All right, so it's equal to NPV is 12% discount rate, and I'm going to look at the future cash flows, and I'm going to add back the negative initial investment. All right, so again, Excel is insisting on formatting this as a percent. I don't know why, but I'm just going to format this back to dollars. Okay, and I want to actually take a little note here. The Excel NPV function only calculates the present value of future. I cannot emphasize this enough. All right, so let me just put this in bold. Calculate, the present value of the future cash flows. To get the finance NPV, need to subtract the initial investment. Okay, initial investment manually. All right, so that is a very important note. I just showed you two ways to get the Excel NPV. All right, to get the finance NPV. Okay, all right, example number 2. So let's just look at this one here. But investment requires, the following cash outlay. All right, $10,000 now, and $5,000 a year from now. Okay, the investment will give a cash return of $5,000 annually for 6 years. All right, the first payment is actually coming in after 3 years. Okay, so these are the cash inflows and outflows from this project. The risk-free rate is 6%. If the proper discount rate is 12, would you accept this investment? All right, so this is really about calculating All right, analysis. Well, we need to find the NPV of this project. If it is positive, we're going to take it. If it is negative, we're going to discard it. Now, back to example number 1, you have positive NPV projects here for A and B. So if you have enough capital, you should take both. But if you can only take one of them, then you should actually take A, because A has a higher NPV, so A actually ranks higher, than B. Okay. All right. So let's just look at the cash flow, and let's just look at the timeline from this example number 2 here. This is period 0, and this is 1 here. This project is going to generate, this investment is going to generate cash inflows for the following 6 years. The first one is actually coming in after year 3. So it looks like we need 9 years. Okay, so I can actually leave 12 years here, not a problem. All right, so I'm going to look at, the cash flows per period. Okay, I'm going to look at the cash flows from this project. All right, so I know that, the first payment is going to come in year 3. That is the cash inflow from this project. That's $5,000. Okay, and it's going to be for 6 years. So I need to go from year 3, not to year 9, but to year 8. Okay, if you actually do a count, Excel says you have 6 numbers here going from year 3 to year 8, because you include both year 3 and year 8 and the years in between. All right, so it turns out these are not necessary, so I can just get rid of them. And here, you have to invest in this project. So today you invest 10,000. All right, and in 1 year you invest another 5,000. Okay, so now I'm going to look at, hey, what is the present value of each cash flow? Okay, so I'm going to look at this $5,000 here in year 3. All right, this is the cash flow from the project. So yes, I should discount this at the proper discount rate, which is 12% here. Okay, and I want to bring this back to point 0. So I'm discounting this for 3 periods. All right, and that's $3,558. And I can actually copy this across. I get the other present values. I can double check. This is 5,000 discounted for 4 periods, so we're good. All right, so this part is very straightforward at this moment. All right, now, what about these 2 things? Well, some of you will say, well, this 10,000, I don't need to actually, do any discounting. Okay, why? Because you're looking at the same time point. All right, it's a present value already. Okay, now here, what is the $5,000 present value here? All right, some of you will say, all right, I'll just, copy, this formula across. Okay. Well, there's nothing here in period 2, so Excel actually fills up a 0 here. So if you don't like it, you can get rid of that. Now, if you look at what you did, you're actually discounting this 5,000 at the 12% discount rate. Now, is this appropriate? Well, this is not appropriate because this $5,000 is not the cash flow from the project. Instead, it is the cash flow going into the project. So standing at today, you know exactly in 1 year, you're going to put $5,000 into this project, into this investment. Okay, so this is certain. All right, this $5,000 need is certain in 1 year. So the simplest way for you to make sure you will have $5,000 in 1 year is to actually buy some T-bills and or put some invest in the risk-free asset. And if that's the case, you should really discount them at the risk-free rate. Okay, and so that is telling you if today you set aside $10,000 for this investment, and you set aside another $4,716 on the T-bills, then in 1 year the T-bill is going to become $5,000, and you can use the $5,000 to invest in this project. All right, so if that's the case, I can now actually add up all these numbers here. So these are all present values. They're all defined at time point 0. Yes, I can add them. So this is $1,671. Okay, so this is the net present value of this project, and it's a good project. You should consider taking this. All right. So that is a very simple review of NPV and NPV rule. All right. So now I'm going to move on to IRR and IRR rule. Okay. So IRR, we have discussed the applications already in the previous lecture. Okay. IRR, APR, EAR, and its applications. All right, IRR stands for internal rate of return. So if you want to actually, internal rate of return, okay, all right, internal rate of return. So if you want to actually, find this, IRR, what you can do is actually, is effectively solve this equation. Okay, I copied this equation from my lecture note, so this is actually working very well. So you just find a discount rate that makes the NPV equal to 0. Okay, that particular discount rate is called IRR. All right, now why internal? Why do we call this internal rate of return? Because, all right, this discount rate is only a result of the project itself. All right, it has nothing to do with the other market conditions. Okay, as long as the project is going to generate these cash flows, if as long as you spend this initial investment on it, then you can actually find a discount rate that makes the present value or makes the net present value equal to 0. So the IRR is really measuring the merit of this project per se. That's why we call it internal. All right. So that is IRR, and IRR rule. Well, IRR rule is a decision-making rule. So basically, this is saying, if you are going to consider single projects, okay, well, you would have to consider IRR and compare that to a cutoff discount rate. Okay, you will take the project. All right, if IRR is greater than the cutoff discount rate, okay, and you're going to reject the project if IRR for this project is less than the cutoff discount rate. Okay, so now you're actually looking at the rule making situation. All right, so if you have let's say a 20% IRR from the project, and if your cutoff discount rate is only 10%, then according to this rule, you should actually accept this project because your IRR is actually 20, your cutoff discount rate is only 10%. All right, so that is this is the IRR rule. All right, if you want to actually rank for multiple projects, well, rank them based on IRR. All right, but as you can see later, there can be issues. All right, when you actually use IRR. Okay, there can be issues when you actually use IRR, when using the IRR rule. So what you can do is actually, if this is the case, all right, resort to NPV rule, if this is the case. All right, I'll explain this in a bit more detail in a second. All right, so that is the IRR and IRR rule. Okay, you already see how to actually calculate IRR. All right, so I'm going to look at example number 3 on your lecture notes. Okay, and this is actually asking the 2 projects in example number 1. All right, so we have these 2 projects in example number 1. So I'm just going to copy and paste it here so that I don't have to set up this question again. All right, so these are these are the 2 projects. Okay, so now if I want to calculate IRR, well, I can actually calculate IRR by doing the IRR function here And notice that, in this case, the cash flows only change signs once for both projects. So there is only one IRR, all right? So I'm going to actually take all the cash flows, and because there's only one IRR, so I don't have to worry about the initial guess or the initial, IRR, initial number I want to put down, all right? So that's actually 41%, okay? And I can actually copy this across. So IRR for B is actually 44%. All right, so now you actually have a very interesting situation, because if you compare NPV, well, at 12% discount rate, A is preferred, okay, because A has a higher NPV, all right? But if you look at, IRR ranking, B is actually ranking higher than A because B actually has a 44% IRR. So B ranks higher. So in this case, you may actually arrive at different conclusions if you go by NPV rule versus by IRR rule. In this case, we know the ultimate good standard is to look at NPV. Okay, all right. So these are NPV and IRR rules. These are the two most important rules for CFOs. Okay, there are sufficient evidence from the corporate America, indicating that CFOs indeed they actually use NPV and IRR rule for their financial decision making. Okay, for capital budgeting projects. All right, there is a survey by two professors from Duke University, and in that survey, they actually surveyed a lot of the CFOs, and over 70% of them saying they are actually using NPV rule. Right, another 20+% of them saying they're actually using IRR rule. Okay, so that's why we discussed this too. All right, in your Finance 201, you may have other rules like payback rule and so on and so forth. Okay, so we don't have to deal with those things in this class. All right, so now I'm going to actually look at example number 4 here. Okay, if you look at my lecture note, I do have a little table that summarizes, the NPV versus the IRR rule for single projects versus for mutually exclusive projects. Okay, and we know the answer. If there is any discrepancy, you should actually go back to NPV. All right. So now let's look at example number 4. This is actually about NPV and IRR for two projects, okay? So consider project A and B, all right? Both projects have the same initial cost of $500, but have different cash flow patterns, all right? Where is the cash flow pattern? Well, the cash flow pattern is actually in the Excel spreadsheet, all right? So let me actually provide you with the input here, all right? So we're going to look at two projects, project A and the project B, okay? All right, so project A, project B, and we have the year here, all right? And we're talking about a 5-year horizon. So this is 1 year from today, and I just need to have 5 years here, all right? And both, projects actually require $500 initial investment, okay? So this is 500. So that's the same, but they have different cash flow patterns. So let me just give you the cash flow patterns here. So for A, I'm just going to actually copy the input from my, from the setup. Okay. All right. So that's the cash flow pattern for project A, and this is the cash flow pattern from project B. And the discount rate here in this question is, right? Let me go back to the question. The discount rate is 15%. Okay, that is a very important parameter. So how about I use a cell for that, 15%. Okay, if that's the case, can you actually find the NPV and IRR of these two projects, and can you rank them? Okay, and this is also asking what if the discount rate is actually 8%. Okay, will your conclusion change? All right, will the calculation change your ranking? All right, so that is, what we are doing now. So I'm going to consider the NPV for these two projects. I'm going to look at the discount rate of 15% for the moment, and later I'm going to change this to 8%. All right. So I'm going to use the Excel NPV function here, even though this function is actually messed up. So I'm going to do NPV, discount rate is 15, and I'm taking all the future cash flows. All right. And so if I do that, I only get the present value of the future cash flows. And now I need to actually manually subtract the initial investment. All right. This is negative already, so I just add. All right, so this number is hidden because it's trying to display as a percentage. All right, so that's $74.42. That's the NPV for project A, okay? And I can do the same thing for, project B, and these are the, cash flows in the future, and then I put back the initial investment. All right, so again, this number is not showing. All right, so at 15% discount rate, B is actually having a higher NPV. All right, so can I actually get IRR here? Well, of course, you can get the IRR here. So I can just do IRR, and I'm going to take all these cash flows. You notice the difference between the NPV function and the IRR function. When you are doing the NPV, you only take the future cash flows. You manually subtract the initial investment. When you're doing the IRR, you take all the cash flows, including the initial investment. All right. So the IRR for A is actually 20%. IRR for B is actually 27. But I want to actually bring up a little decimal here. All right. And yes, 19.77 versus 27.38. All right. So at 15% discount rate, B is preferred. If you look at NPV, because B has higher NPV. B is also preferred if you look at IRR, because B has a higher IRR as well. All right. So the conclusion is, I should say, at 15% discount rate. All right. Maybe I should actually insert one row here just to actually make it not so jammed. All right. And now I can actually say, hey, what about 8% discount rate? All right, can I actually copy, these things, down here? Well, I may have some issues here. So let me just, look at this one here. So this is all messed up. So I just need to clean up, what I should probably, do this all over again. All right. So this is equal to NPV. The rate is now 8%. I don't have an 8% cell. So let me just say, discount rate is 8%. Okay, all right, so NPV at 8% here, and if I want to be able to copy across, I might want to lock down the 8%, okay? I'm taking the future cash flows, I'm putting back the initial investment, all right? So that's 216.64, all right? So at 8% discount rate, NPV for A is actually $216. And can I copy this across? Yes, you can copy this across. You get 212.11. All right, so that is the NPV for B. All right, so now immediately you realize that your preference has changed. At the 15% discount rate, B has a higher NPV. At 8% discount rate, A has a higher NPV. Okay, bear that in mind. All right. Now I'm going to do the IRR, and I'm just going to do the same thing here. And you notice that, hey, IRR does not change. Well, that's what we expect, because as we said, this is the internal rate of return. So it does not have anything to do with the discount rate. It's just measuring the merits of the discount rate, of the projects. Okay, so you see that at 8% discount rate, your preference, if you look at IRR, is B is preferred. But if you look at NPV, A is preferred. So we have a situation here. The conclusion changes when the discount rate changes. So how do we address this? All right, so the ranking changes when the discount rate changes. Now what? Okay, So we just, experimented, with two arbitrary discount rates. One is 8%, one is 15%. And we noticed that, this actually has, implications on our conclusion. So what should we do? Well, treat this as like a little research project, okay? So I'm going to further, examine this, okay? I'm going to, look at, or I'm going to look at a list of discount rates. All right, I'm going to look at a list of discount rates, and I'm going to look at, what is my preference or what is my ranking, when the discount rate is actually changing, according to the list. All right, so here I'm going to actually look at discount rate, and I'm trying to model the discount rate now. Okay, so I'm going to actually look at discount rate as low as 0. Okay, which is killing the time value for money, and I'm going to increase this by 2%. Okay, watch me closely. I'm actually modeling the discount rate now. So I'm going to look at 0, 2%, and 4%, and each time I increase the discount rate by 2%. Okay, so how high can it be? Well, maybe I can actually stop at, I don't know, 30%. Okay, that's arbitrary. All right, and if this is not enough, you can actually have much higher discount rates if you like. All right, until you can actually arrive at some conclusion. Okay, all right. So now I'm going to say, at the corresponding discount rate, what is the NPV for A and what is the NPV for B? All right. So now I want to build a strong formula and a copy down for project A NPV. All right, so you can actually pause the video here for a second and think about what is the NPV function you can actually put down here. All right, so I'm going to do equal NPV. The discount rate is here, and I'm going to look at the cash flows in the future for project A, and I want to be able to copy down. So I should lock down those cash flows. Those are the future cash flows, and then I manually put back the initial investment. All right, so I should also lock down the initial investment. In this case, I'm actually looking at the NPV for A in a robust manner, in the sense that now I can actually copy down this NPV calculation. Okay, so this is a 450. So if there is no time value for money, you're just going to get 450 out of project A, and I can easily verify this. When I actually select all these numbers here, Excel says you have 6 numbers you're adding up. The summation is actually 450. Okay, excellent. This is verifying that when there is no time value for money, you can simply add all these numbers together because they actually now have the same timestamp, because time value for money is gone. All right, and now I can actually copy these down here. And you notice what I did. I actually, let me go back. All right, Control Z, I went back, and I put my cursor here. It becomes an arrow, it becomes a cross, and I can actually double click. Okay, and so, this calculates the NPV, all right, for all the different discount rates. Now, some of you notice that some of the numbers are negative. Okay, is that a problem? What does it tell us? I'll get back to this in a second. All right. So now I can actually look at, a project, B NPV. All right, I'll just do the same trick. This is the discount rate, and I'm looking at the future cash flows. Okay, whoops, there's an extra one. I don't need to have the extra one here. All right, I need to lock down the cash flows, and then I need to put back the initial investment. I need to lock down the initial investment. Okay, and this is now saying, if there's no time value for money, project B has an NPV of 350. And yes, that's 350. Okay, and now I can actually do the same trick, right? So this way, I actually calculate the NPV for B for the corresponding discount rates. Okay, now what about this negative value here? So if you look at this one here, this is when the NPV for A actually changed signs. All right, at 18%, NPV is positive. At 20% discount rate, NPV is negative. So somewhere between 18 and 20%, NPV is going to be 0, right? Because it's going from positive to zero and then to negative. And then we know when the NPV is negative, that discount rate is the IRR. And we know the IRR for A already. That's 19.77. So yes, 19.77 is between 18 and 20. That is a very nice observation. All right. Following the same logic, if you look at project B, well, this is when the NPV actually flips signs. At 26%, NPV is positive, and 28% NPV is negative. So somewhere between 26 and 28, NPV is actually 0. And we know the answer, that's 27.38, because that is the IRR. All right, very nice observation here. Okay, so bear that in mind. And I'm actually going to plot the, two NPVs into a graph. Okay, I want to do this exercise because I want to be able to actually, draw some conclusion. As we said, this is like a research project now. Okay, I'm trying to actually, draw some conclusion, and I want to actually, plot, a graph. Okay, so if you want to actually plot a graph, you can actually highlight all this data here, and you can actually let me bring back my ribbon here. Okay, and you can actually say, how about I insert a chart? Okay, and I don't know what is the appropriate chart type, so I let Excel decide. So there's something called recommended charts. Right, click on that one here, and there are a bunch of charts for me to choose from. It looks like this one might be what we need. All right, so let me just pick this one here for a moment, and now I have a chart here now. So you can actually do some charts here, and this is the object. So you can actually select this and press Ctrl+C, and go back to your PowerPoint and press Ctrl+V. So you can actually copy and paste this chart into your Word document, your PowerPoint document, and so on and so forth. All right, and this title is actually not so intuitive, so I'll just say, NPV is a function of discount rates. All right, that's the point. Okay, so and then I have these two series here, and I don't know which one is which, so I should probably rename them. Right, and how do you rename them? Well, you can actually go to right click on the chart and go to select select the data here, and this series 1 is you can actually edit. Okay, Excel says I'm using the numbers in column B to plot the series 1. Well, the series 1 is actually NPV for A. Okay, whoops, NPV for A. All right, so that way the name is actually quite intuitive, and I do the same thing for series 2. All right, click edit, and I'm going to say NPV for B. All right, and this actually is using the numbers in column C. Okay, so click OK, and now this actually is a nice looking chart because it's actually less confusing now. All right, so now you see. You can also do a lot of other, cosmetics for this chart, including, for example, data label and the trend line, all these kind of things. Okay, I'll leave that to you. All right. So now the question is, what can we take away from this chart? All right. So let me actually make this chart a little smaller so that we can actually. I'm sorry to make this a little more, a little more ugly. All right, so the takeaway. All right, so first of all, both NPV lines or NPV curves are downward sloping. Yes. Okay, so the higher the discount rate, the lower the NPV. All right, and this is true for both of them. All right. And secondly, you notice that the two NPV curves intersect at one point. Yes, we clearly notice that there's one discount rate that makes the NPV for these two projects equal. Okay, that's what we mean by intersection. All right, so the question is, can you find the discount rate? Well, in this case, we actually call it crossover discount rate. Okay, can you find this crossover discount rate? Well, some of you will say, well, I can actually look at where this is. Okay, so it looks like it's somewhere between 8%. Yes, all right, it may not be exact. Now, another way for you to look at this is to look at the difference between the NPV for these two projects. And when they are intersecting, then the difference is 0. So you should actually look at, I don't know, maybe you should look at somewhere around 8% here. This is 216, this is 212. So the difference is about $4. All right, and if you go, to the next 10%, that difference is actually larger. And if you go back to the previous 6%, that difference is larger. So, that's going to be somewhere around 8%. But can you find the exact number? The answer is, of course. I'm going to use Excel Solver. Okay? I'm going to take a guess. So this is a very good review of the Excel, on the solver functionality. All right, we discussed that, in the first, time value for money and discounted cash flow, chapter. All right, so step number 1, I'm taking the guess. Okay, and I'm just going to guess 8%. All right, so that, that's actually that's an educated guess because I looked at the picture and it looks like it's somewhere between 8%. Okay, step number 2, remember, when you're using solver, you're always using the guess to calculate something. All right, so here I'm going to calculate the NPV difference. All right, so in order for me to do that, I'm going to calculate NPV for A, and I'm going to calculate NPV for B, and then I'm going to calculate the difference. All right, so follow me here. I'm going a little fast, but that's okay because you can actually pause the video, if this is actually, too fast. All right, so this is now equal to, NPV. I'm looking at the discount rate, and remember, use the cell reference. Okay, make sure there's a link between these two steps. All right, I'm looking at the cash flows for A, so I need to scroll up here. This is the cash flow for A in the future, and then I'm looking at this formula bar now. Okay, and this is actually manually subtracting the initial investment. All right, so that's good. That's the NPV for A. It's 216. That actually replicates this number here. Okay, except it's in percentage. This is really annoying, so let me get the dollars. All right, so NPV for B, I'm going to look at the rate here, which is, again, the 8% guess. Okay, now I need to look at the future cash flows for B, and I need to close the parentheses and put back the initial investment. All right, so this is 212, right? So this, well, I don't want to have a percent here. So the difference is 216 minus 212. All right, that's $4.53. Now, step number 3, you're going to actually invoke solver. Okay, you want to actually find the crossover discount rate that makes the NPV equal to each other. That makes the NPV difference 0. Okay, so I'm going to set M, what's the cell reference? Is the M93 equal to 0 by changing my guess in M. All right, what is this? 89. Okay. All right, and the solver should actually, find this crossover discount rate for me. Okay, so let me go to data. Last time I discussed how to activate solver. Go to solver, and I'm looking at my solver setup here. This is my objective. I want to, solve this to be 0. I'm going to do this by changing my guess. Okay, there's no other constraint, so we're good. And click solve. Excel says I found the solution here. It's actually, 8%. Whoops. I think I forgot to actually click OK. All right, so that is the difference. And to click solve. All right, solver says keep the solver solution. Yes, I want to keep the solver solution. Okay, so it's actually showing up as 9%, but if you actually show the decimal, it's 8.51. All right, So that is the crossover discount rate. That's the second observation. All right. And you also notice that, now that you have this, crossover discount rate, you actually have the preference, changing once, the discount rate crosses this crossover discount rate. Okay. So, NPV, I should say NPV for B, I should say NPV for B is lower, okay, before the crossover rate, okay, and it's higher, okay, it's above the NPV for A, after the crossover rate, right? So that's what we observe, because B is the brown line, so the brown line is actually lower, so before the crossover rate, so that means A is preferred. All right, because the NPV for A is higher. Now, after the crossover rate, B is actually preferred because B is now above A. All right, but you notice that, maybe there is one more observation. Both NPVs intersect. Well, they intersect with each other at 8.51, but they also intersect with the x-axis. All right, at what is the intersection point? Well, that's just the IRRs, right? So if you look at A is going to intersect with the x-axis at about 19.7, at about 19.77%, because that's the discount rate, that's the IRR for A. And if you look at B, well, that point is actually, what is the number here? 27.38. Okay, so now you can actually look at, in general, what is the conclusion we can draw here? Well, in general, you're looking at different ranges with the discount rate, right? So I can actually look at the universe of discount rates can be split into the following intervals. All right, so I'm going to look at the intervals here because I have three interesting discount rates. The first one is the crossover rate. The second one is IRR for A. The third one is IRR for B. So anything less than the crossover rate, which is 8.51. All right, I should say interval. Okay, just to make it clear. And then I should say your preference. Okay. All right. So anything less than the 8.51. All right. Which one is preferred? Anything less? Well, A is preferred. Okay. And if anything is, if the discount rate is actually, over 8.51, but, it's actually, less than, and I'm using R to denote the discount rate. Okay. But if it's actually less than, let's say, well, I should say, 27.38, right? Because that is the, IRR for B, okay? So 27.38, all right? If, I'm looking at this point here through this point here. So B is preferred, okay? Because B is above A, and B still has a positive NPV because, the part of the NPV B curve is actually above the x-axis. All right, anything greater than the 27.38, well, what's the conclusion? None is preferred because both A and B, they end up having a negative NPV. So you don't want to choose any of them. All right, so this is our final conclusion here. All right, so this is a very interesting research project because we're able to actually narrow down our conclusion, to look at how different discount rates can actually affect our preference. Okay, so now you give me any discount rate, I just look at where the discount rate falls in these three intervals, and then I'm going to give you my conclusion. All right, so this is apparently very nice. All right. So that is example number 4, and I have 1 hour already in this video, so I'm just going to, well, Let me pause here for a second. All right. I have one example left in this chapter 4. So I'm going to finish this and, I'll leave the chapter 5 for part 2. Okay. All right. So this is actually one example about capital budgeting. Oops. Capital budgeting when there is tax. Okay. And this is a very, very important example. So if you are a little tired at this point of the video, I suggest you take a little break and, come back when you feel, recharged. All right, example number 6. Okay. Again, please have your lecture note on your side. All right. Sally and Dave, this is a young couple, fresh out of business school with a little cash to spare. They are considering buying a nifty condo as a rental property. Okay, we know the U.S. housing market is surging at this point because of all the money printing and so on and so forth. And I think one of the largest asset management companies, I believe, is actually BlackRock, is actually buying every house they can. All right, so what does it mean for you? All right, I know my house has appreciated to over like $400,000, and that is absurd. We paid $327,000 when we bought the house, but now the housing market is really surging. All right, so in this case, this couple is actually thinking about buying a condo as a rental property. All right, the condo will actually cost $100,000, and they're planning to buy this with all cash. Nice, they have all the cash. And here's some additional information. All right, Sally and Dave figured that they can actually rent out the condo for $24,000 per year. All right, so I'm just going to actually put down the inputs here. Okay, so this is the setup. All right, so this is the annual rental income. All right, this is actually $24,000. Okay, and then they will have to pay property tax. Okay. Property tax, that's actually $1,500 per year, right? Very nice. You can actually do, the algebra, 1,500 divided by 100,000. Looks like that's the property tax rate. So you can actually decide, is this in Connecticut? Well, we know Connecticut is taxing people to death. So it's really one of the states that has the highest property tax rate. All right, and then you also have all the expense. And that's going to be $1,000 per year, right? So and all the income from this condo, you have to report them on your tax return. And now the tax rate is actually 30%. Okay, so every every dollar you earn, Uncle Sam is going to take away 30% of that. Right, and they will continue this tax rate for the foreseeable future. All right, and here we're talking about a capital investment, because this is actually something you spend on and then you can actually use for the following 10 years. Okay, so this is the capital investment, so you can actually there's tax, so you can actually have depreciation. All right, so annual depreciation. All right, so in this case, there are many ways to actually depreciate the capital investments. All right, so here, we're just going to do a straight line. So what you can do is actually, you have the condo price. Well, I don't have the condo price here, so let me just insert this condo price here. All right, the condo price is actually $100,000. All right, so, and this, I think the horizon is actually here as well. So let me just put back the horizon. This is actually for 10 years. Okay. So you can actually look at the annual depreciation. If you're going to do the straight line depreciation, you're just going to divide the annual condo price by, the condo price by number of years, you can actually rent this. Okay. So every year you're going to depreciate $10,000. And at the end of year 10, the condo will be fully depreciated. All right, so that is actually known as the book value, right, or the residual value of the condo. Okay, And if that's the case, all right, and we do have the discount rate for this couple here, and the discount rate for this young couple is actually, what is this? I don't have a discount rate here, so let me just look up the discount rate. It's actually 12%, all right? So discount rate for this young couple, for this condo investment, that's actually 12%. All right, so if that's the case, the question is, do you want to buy this condo or not? Okay, so this is a capital budgeting project, capital budgeting problem, all right? Okay, capital budgeting problem. All right, need to calculate the NPV. Yes, if the NPV is positive, yes, they should go ahead and invest in this condo. If the NPV is negative, no, they should not invest in this condo. It's simple as that. But how do we calculate the NPV? Well, in order for us to calculate the NPV, you would have to consider a lot of things. For example, all this annual rental income and all the property tax you have to pay, all the other expense you have to pay as well, and then you have to pay the tax and so on and so forth. All right, and there's one more thing here I like to emphasize. Okay, I'm going to say at the end of year 10. All right, so if you look at the book value, I should say the condo price, the total depreciation. Well, the total depreciation is going to be every year you depreciate 10,000 and you have depreciate for 10 years. So you have depreciated every penny of the condo. So the book value of the condo is going to be zero, right? Because you paid $100,000 for it and you have depreciated every penny. So the book value is zero, okay? But this is about a real estate condo. So we know that, if the location is nice, well, you may actually have a very good market value out of the condo in 10 years, okay? So here, I'm just going to say, let's just say, the market value of the condo is actually 80,000, all right? So imagine this is a very nice, condo and very nice location, all right? Everything about real estate is location, location, location. So in this case, let's just assume, excuse me, market value of the condo is actually $80,000. So if that's the case, you actually have a very interesting situation. Why? Because your book value is zero, your market value is actually 8,000. So you actually realized a capital gain on this, and Uncle Sam says, "Please pay me tax." Okay, so you should have, this, taxable gain. Taxable gain is the difference between the market value of the condo and the book value of the condo. All right, and you have the 30% tax rate. So the taxes you're going to pay is apparently the 80,000 times the 30% tax rate. All right, so that's going to be $24,000. So you can actually look at after-tax capital gain. All right, so that's going to be the 80,000 taxable capital gain minus whatever tax you pay. So that's 56,000. All right, so bear that in mind. This actually is a one-time, after-tax capital gain because, you actually can sell this condo for, 80,000 at the end of year 10, and your book value is zero. So yes, you can actually pocket in, not all of it, but 70% of it, which is actually 56,000. All right. So now I'm going to use the timeline and calculate the after-tax cash flow per period. Okay, after I calculate the after-tax cash flow, then I can actually start to think about, hey, what is the present value of each cash flow, and finally, what's the NPV of this condo investment? All right, so I'm going to actually build a simple timeline here. All right, this is today, and this is do I want to build a vertical timeline or do I want to build a horizontal timeline? All right, well, I think that is vertical timeline is fine. All right, so this is one period from today, And we have 10 years here. Oops, this is way too much. All right, and get 3 more. All right, so now I'm going to look at after-tax cash flow per period, okay? So today, you're going to invest in this condo, so that is negative 10,000, all right? And then let's look at the first year cash flow after you pay the tax. Well, first of all, you're going to rent this out for 24,000, and then you're going to pay the property tax, and then you're going to pay the other expense. So that is going to be your, it's like your profit, right? So, and so now you have to pay tax. Well, what about the depreciation? So it turns out in this case, there are 2 ways for you to actually, calculate the after-tax cash flow when there's depreciation. So let me slow down here, all right? Calculating the after-tax cash flow when there is tax and depreciation, okay? So let me just say E is the earnings, all right, earnings before tax, and D is the depreciation, okay? D is the depreciation, all right? And then I'll say T is the tax rate, okay? If that's the case, method 1, you can actually look at, I should say after-tax cash flow, okay? Just to avoid any possible confusion here. This is very important. This is going back to your accounting class. If you're a little rusty, please review your accounting notes. All right, so after-tax cash flow is going to be, first of all, you have the earnings, and then you can actually, take out tax, you can, take out depreciation, and, you actually pay tax, so you get the leftover, which is multiplied by 1 minus T, and because you take out depreciation, so now you have to actually put back depreciation. All right, so that is one way, okay? That's approach number 1. All right, method number 2, well, this is equivalent. It differs, when you actually consider the, the depreciation. All right, so approach number 2 is you can actually look at your earnings and you say, all right, let me just pay tax, okay, 1 minus T, all right? I don't worry about the depreciation. But now I have to actually pick up the tax benefit of depreciation, which is actually calculated by the tax rate T times the depreciation D. So the TD is the tax benefit of depreciation. All right. So, these two are equivalent. You can actually multiply this out and, combine the similar terms. You would actually, arrive at the second approach. All right. So this is a little digression. This is very important. Okay, so let me just make this, bold. All right, so let me get back to this calculation here. The video is actually getting a little long, so I want to actually wrap up this example as quickly as I can. All right, so, excuse me. I'm looking at your annual rental income, and you pay property tax, and you pay all the expense. These are annual expenses. So this is like my E. And then I start to pay tax, which is 1 minus 30%. And then I put back the tax benefit of depreciation, which is the 30% tax rate times the annual depreciation. Okay? So if that's the case, I can actually calculate my after-tax cash flows. And this is $18,050. All right? And if I want to be able to copy down, I need to lock down all these cell reference. Okay, so let me just press F4 for each of these things here. All right, so that's $18,050, and I can copy this down here. And now the only problem is, what about the last period? Remember, in the last period, you can actually sell the condo for the market value, which is $80,000, and you realize the capital gain of $80,000. So you can only keep $56,000 of that. All right, so I'm just going to put back the $56,000. All right, so that is the cash flow in the last period. Okay, so can I calculate the NPV now? All right, if the discount rate is 12%, yes. put down 12% here, and I'm going to look at the future cash flows here, and then I'm going to put back initial investment. And this way, I actually get the NPV of this condo investment. It's a great investment. NPV is actually positive $20,017. Yes, they should invest in this condo. All right, so that is, the analysis here we have, been able to complete. All right, there's one more thing I like to actually bring up here because this is very important. All right, so data table, Excel functionality. All right, it's called a data table. Okay, the so-called what-if analysis. All right, so let me give you a little motivation, and then let me complete this what-if analysis here. All right, so in this, example, the NPV calculation depends on a lot of things. All right, for example, your annual rental income, your property tax, everything. All right, everything you have used to calculate the after-tax cash flow and the NPV. All right, but maybe some of the factors are very important. Okay, so I'm going to pick out two important factors. Okay, one is the annual rental income. Okay, this is directly affected by, the rental market. All right, maybe, the rental market is actually changing quickly. Okay, so that number can be changing. All right, year to year. And the second, factor is the, market value of the condo in 10 years. Okay, so you're dealing with the uncertain real estate market. All right, in 10 years, if you want to forecast, hey, how much can you sell this condo for? Well, that is very, very uncertain. Okay, so, we want to actually understand what if these two factors are different as we specified in this example. All right, so what if these two factors change? Okay, so what's going to happen to your NPV calculation? All right, what's going to happen to your IRR? All right, and actually in this case, I just forgot, you can also calculate the IRR based on this, after-tax cash flow. All right, so I can actually look at these cash flows all together, and the IRR is actually 16%. So that's great. This is actually greater than the cutoff discount rate of 12. So yes, it's a good investment. All right, it's actually 15.98. All right, so the what-if analysis is actually addressing this. And in Excel, we can only do at most a two-dimension data table. Okay, so this is because we only have a row and a column. So, you can actually put one variable in a row and put another variable in a column. So you can actually do a two-dimension data table at most. All right, some of you will say, what if we have three factors that are very important? Well, unfortunately, you cannot do the three-dimension data table in Excel. Well, you can certainly do only one-dimension data table. That's not a problem. You can only choose to model, one factor and look at the implication of this factor on, your conclusion. All right, so here I'm going to actually, pick out annual rental income. All right, and I'm also going to pick out, the condo market value in 10 years. Okay, so I'm going to actually, pick out all these two variables, these two factors, and I want to actually look at what's going to happen to my NPV or IRR. Right? So I'm going to actually, look at annual rental income. This is 24,000. Okay, so I'm just going to look at 24,000 here, and this is 8,000. All right. Now, in order for me to actually, finish this data table, I would have to, build a link. Okay, so this is very important. Need to build a link between the inputs in H129 and H130 and the NPV calculation. Okay, so to some extent this is like solver. when you're using solver, you need to actually make sure there's a link between your guess and the quantity you calculated in the second step. So here, you want to make sure there's a link between the annual rental income and the market value of the condo. All right. So how do I actually, make sure there's a link? Okay. So I'm going to look at this one here. This is, the condo price. I don't have to touch it. And here, I'm going to look at where is the annual rental income. The annual rental income was actually from this cell here, C113. So I could have used the C113 here, but if I want to actually build a new cell just to emphasize these two are factors we picked out, I'm going to change this C113 into this number here, okay, H129. All right, so let me lock down here and let's keep going, for the rest. So the rest is good. That is $18,050, and I can actually copy these down here. All right, and now there's one more thing I need to pay attention to, which is actually the market value of the condo in 10 years. Okay, so that's the $80,000 here. And remember, when we actually look at these after-tax cash flow, we put back this C116, and whoops, that is all right. So let me slow down here. I'm confusing myself. So this was copied down from the previous calculation, and now we have to put back the after-tax capital gain at the end of year 10. All right. So what I'm going to do here is very straightforward. I'm going to take the 80,000, and I'm going to do minus the book value of the condo, which is actually 0 here. Okay. So that is the capital gain I'm realizing, and I'm going to actually multiply this by 1 minus the tax rate, which is the 30%. Okay. You see that I just changed all the calculations by inserting this, a link between, the inputs I set up and, the calculation I'm doing here. All right. So now, these numbers are back. And if I change this to 25,000, okay, my NPV changes. All right. So that's good. So let me get back to 24,000. If I change this to 50,000, my NPV changes as well. So that's good. All right. So I just manually verified there's a link between these two inputs and in my NPV calculation, and my IRR calculation here as well. All right, so this is like step 1. Okay, if you want to make a little analogy, between this one and the solve, and this is like the step 2. All right, so step 3. If I want to build a data table here, I'm going to actually set up one factor in a row, set up the other factor in the column. Okay, let me elaborate what I mean by this. All right, so I'm going to set up the annual rental income in a row, and in this case I'm talking about 18,000, as low as 18,000, and as high as, I don't know, I'm just proposing $2,000 increase each time. So 18,000 to 20, 22, 24, 26, and 28. Okay, so these are the reasonable ranges for the annual rental income. All right, so my estimate, or our market analysis says the annual rental income could be as low as 18,000, could be as high as 28,000. All right, so now watch me closely. I'm going to look at, this is the annual rental income in a row. Okay, so this is one row here. This is row 137. I'm actually devoting this row to modeling the annual rental income. All right, so here I'm going to actually look at the market value in 10 years in this column here. All right, so I'll say the lowest market value is going to be 50,000, and I'm going to increase this by 10,000 each time. All right, and 50, 60, and where do I want to stop? Well, just for illustration purpose, I'll stop at 110,000. Okay, so this is the market value in 10 years. All right, so this is actually in a column. Okay, all right, so this is, in a column, and this is any rental income in a row. All right, so now I'm ready for my data table. All right, if you are confused at this moment, you might want to pause the video here and look back, at what I did. So now I'm going to actually, look at this top left corner. All right, so this is telling me I want Excel to do the following. All right, when the annual rental income is 18,000 combinations. All right, so for example, if the annual rental income is 26,000, if the terminal value or the market value of the condo is 90,000, can you actually put down the NPV here? All right, you can actually go through this manually. All right, so if you want to actually do this manually, I'll just say this is 18,000. All right, and this is 50,000. So this number is actually negative 10,475.35. All right, so I just finished the one. Okay, and now I can actually keep going. All right, so this is now 20,000. All right, and so this number is negative 2565.04. So imagine you can do this manually, but you don't have to. Why? Because you can actually use something called a data table. All right, so what I'm going to do here is very straightforward. All right, I'm going to use the top left corner, and I'm going to actually copy this formula for NPV calculation and put it down here. All right, so now I'm going to highlight everything. What do you mean by everything? Everything includes the top left corner, the column input cell, and the row input cell, and the cells you want to populate. All right, so now this is, watch me closely. All right, I'm going to go to data and what if analysis and data table. All right, so now this is where you're going to set up your data table. All right, so Excel says, what is your row input cell? Well, the row input cell is row 137. And in this row, I'm actually modeling the annual rental income. And what was the annual rental income cell I used when I calculate the NPV? Well, that number is in this particular cell, H129. Okay. One common mistake is for people to actually look at, this, any of the numbers in this, row 137. That's not right. Okay, that's not appropriate. You let Excel plug in the numbers in this row 137. You just tell Excel what was the input you used when you actually calculate the NPV. So in other words, you're actually training Excel. Okay, Excel is very smart. All right, and you can also look at what's the column input cell here. Well, the column input cell, we actually model the market value of the condo in a column, and this is column E. All right, and what was the input you used when you calculate the NPV? Well, that was the input I used. All right, so that's H130. So once you're ready, the data table is surprisingly simple. All right, let me click OK, and now you see that I have all the numbers populated. All right, so now you see that if the annual rental income is only 18,000, if the terminal value is 50,000, then this is not a good investment. All right, your annual rental income is 18,000. These numbers are negative. Okay, and of course, at this bottom right corner, this is very good situation for you because the terminal value is the highest, and the annual rental income is the highest. So this is really working the best for you. All right, so this is a very simple illustration, and I can also do another data table for my IRR. I'll leave that to you. Okay, and if you click on one of this, Excel says this is actually the data table, and if you try to do this, Excel says you can't do that because it's part of a data table. All right, so when you look at this formula bar here, you see that Excel is telling you these numbers are actually out of a data table. All right, so this is a very good tool for us to perform the sensitivity analysis or the what if analysis. All right, and of course it's up to you to decide or justify what is a reasonable range for the annual rental income and a reasonable range for the terminal value of the condo in 10 years. All right, so I'm finishing this video here. I realize this video is a bit long. It's an hour and a half, but please watch every second of it. And if you are a little tired, you might want to actually pause and come back. Okay. All right. I'll stop the video right here.